Well, it was a weekend of worry. That is not how it played out. HSBC actually acquired the UK assets, the British assets of Silicon Valley Bank. But for the Silicon Valley Bank, emergency measures were used, and we are talking about that this morning. That was the House Speaker, Kevin McCarthy, joining me yesterday on Sunday Morning Futures, reacting to the country's second largest bank failure in Silicon Valley Bank. Joining me right now is the Bear Traps Report founder, New York Times bestselling author, Larry McDonald. And Larry, it's great to have you this morning. Thanks very much for being here. I want to get your take on these emergency measures. How do you see things?
Well, first, let's back up a second. When you suppress the cost of capital for longer and longer and longer periods of time, you incentivize bad behavior. And, as you know, I wrote the book on Lehman Brothers. It was a New York Times bestseller. And what I saw inside of Lehman and what we've just learned over the weekend as to the way this bank was managing itself, it's blood curdling, irresponsibility, and the Fed enabled it. And then when they juiced rates up higher, they essentially just blowing up these bad actors.
So they're claiming that this is not a bailout, Larry, because the bondholders and the stockholders are wiped out. Taxpayers are not paying for this. This is money from the fund, the fund which banks pay into. What about these emergency responses? Is this like another introduction or form of quantitative easing, Larry? Because it feels like that's where the conversation on Wall Street is going now, that we just saw a second major bank failure, and now the Fed is not going to be able to raise rates the way a lot of people thought. Assess this response from regulators.
Well, they're socializing the losses. So they suppress the cost of capital. They incentivize bad actors, and now they're socializing the losses. Because at the end of the day, the Fed is backstopping this, and essentially QT, which they promised us would be $90 billion a month, essentially is over, because this is the Federal Reserve using its balance sheet to socialize the losses and provide liquidity to potentially lots of banks. There are a number of banks this morning that are down 50, 60%. So this has got a knock-on effect. They've basically used a Band-Aid, but it's clearly a risk to the taxpayer, because at the end of the day, the taxpayer backs up the Federal Reserve.
So, Larry, you see this as a bailout?
100%. Well, just look at the COVID crisis. It was a $10 trillion fiscal and monetary response. Okay, and the Lehman crisis was only $2.5 trillion, and now we're going into another round of bailouts, socializing the losses with the Fed balance sheet, right? And so your hard assets are going to be an incredible place to invest, because the dollar's weakening globally as the U.S. is moving toward recession. This uncertainty and these bank runs nearly guarantee a deep recession. And then the Fed, and then eventually the taxpayer is going to have to come up with more when they do a real fiscal bailout. Right now we're in the monetary bailout.
Larry, you made a lot of news the other day when you joined me last week. You said that this, based on what your research is telling you and based on your calls with various institutions, that stocks would, you use this word, crash within 60 days. Ever since you said that, Larry, this market has been underwater. We're talking about declines of between 3 and 3.5%. Since you made that call, how much worse does it get, Larry?
Well, we were on the program last week, and all I was pointing out to is that when you look at the yield curve of the 2s, 10s, and that's just looking at where the 2-year Treasury is versus the 10-year, that was ominous. But then the performance of the regional banks, the underperformance has been spectacular. It's been growing weaker. And when you have this kind of dislocation where the banks are in trouble on a regional basis, it just leads to much bigger problems. And then we're not even talking about auto loans and commercial real estate. So it's going to be a really bad, kind of like an S&L 1980s type crisis. The market probably drops 20 to 30% from here, because at the end of the day, Maria, we're trading at 19 times earnings, and we have like literally 4 banks that have blown up in the last week. We've got one more on the way, probably today or tomorrow.
Okay, and I saw your tweet over the weekend about those regionals. You said that you shared this with your client, that all the signs were there. The regional banks were underperforming the S&P 500 by 19% year over year today versus 9% 9 days ago. So you're saying that indicator alone would have had you be selling regional banks weeks ago?
Yes, and we have our index. We've got our 21 Lehman systemic risk indicators. And there's a number of things that have been deteriorating in terms of interbank trust, credit spreads on commercial real estate. I mean, there's just so many things that have been deteriorating. Auto loans. So all the bank assets are in trouble. And the problem is the highest quality assets, right? So not all the bank assets. What I mean is, you know, your auto loans, your commercial real estate. There's a lot of things that are in trouble on bank balance sheets. But your highest quality assets, your treasuries and your mortgage-backed securities, just got really lit up in flames by the Federal Reserve hiking rates 500 basis points inside of 14 months. And remember, when you have these guests on the air, right, they've been claiming that, okay, soft landing, no landing, and they're basically selling us, this is Wall Street strategists, that you can just hike 500 basis points in 14 months and there's a price to pay for that. I mean, this is not free, because when you raise interest rates that fast, you essentially light the high-quality assets of these banks on fire.
All right, we will leave it there. Larry, you just said that this market is having another 20 to 30% fall from here, and you think this emergency response from the Fed is, in fact, a bailout. Larry, it's good to have you on the program. Please come back soon. We'll be watching your moves and your approach to this market. Thank you, sir.
Thanks, Maria.